The point is the 3 rounds are, there's a discovery round, which in my opinion is less than 2 million. So it's usually like maybe a first time founder exploring a new market. It would graduate to the next round, which would be a classic. And a classic round, in my opinion, would be 3 to 5 million. And finally, this is the Megatron jumbo round, greater than 5. It's usually a $6 to $10 million round. And it's almost always a seasoned founder with a prior exit. So when multi-stage firms see opportunities like this, they want to supersize it. And they say, you know what? Instead of raising 4 or 5, why don't you raise 10 and I'll give you the whole thing.
Ed, I am so excited for this, my friend. We haven't done this in a long time. We planned, the world keeps on changing, but fuck it, let's do it now. So thank you so much for joining me today.
I love it. Thank you for reaching out, and I'm glad it worked out. I know we've been planning this for a while, and I think this is number 3 on your show. It's been spread out over many epics, I would say.
I mean, many, many epics. We just discovered that your year of entry into venture was my year of birth. And sorry, I'm
oh, Jesus.
But there is a reason for that. I just want to start with some context before we jump into the seed landscape.
Yes.
For people that don't know you and Boldstart, bluntly, who are you and what do you do?
I call ourselves an inception investor. And in my opinion, the world's gotten way too complicated with pre-seed, seed, and what have you. So we love partnering with founders when they have their idea, helping them iterate and battle test their ideas, helping them pre-sell their hires, and having them be armed and ready at incorporation and leading that round from the very beginning. And those rounds can be anywhere in size. I mean, you're talking about, it could be a few hundred K in size. It could be up to 10 million in size. I would prefer your classic structure of $3 to $4 million, to be honest with you. But sometimes there are some opportunities you just can't let get away.
Okay, we said this would just be a chat. Is that not just pre-seed, dude? That's what pre-seed always was.
I think pre-seed presupposes that you need a seed round. And if you look at kind of the data, frankly, I just did an analysis on PitchBook. The data is skewing upwards. Did you know that the median age of a company that raises a pre-seed round is 1.2 years of age now? And the median age of a company that raises a seed round is 2.7. This is just, I'm talking about data across kind of, the last 10 years. Secondly, I would tell you is that a lot of times founders who are second and third time founders don't want to even be called to have a pre-seed round, because it presupposes you need a seed round. And what does that mean to you, Harry? It means that if you have a pre-seed round and you have a seed round, that's another layer of dilution. So what you really would rather have for the best founders is they just want to get a seed round. I mean, I wish we could just go back to that, but the cat's already out of the bag.
So I totally agree with you. So if we just take the kind of years to pre-seed, the thing that worries me most is you have, and I'm seeing this so much, you have person leave Stripe or leave OpenAI or Hugging Face, and they raise 20 on 100. And that's happening more and more. Can you just help me understand, why do you think that's happening more and more now?
Yeah, well, look, I got to be honest with you. It's gotten really hard to venture. I mean, people raised way too much capital over the last 3 or 4 years. And everyone kept raising funds year after year after year. And the spigot dried out last year. All the big multi-stage firms with the $1 billion plus funds stopped investing in growth. And the data is there. And if you look at the peak, I think the peak was Q4 2021, that about $200 billion was invested. Most recently, it was $73 billion in the last quarter, right? 200 to 73 billion. So that's a massive drop. And let's talk about it. Looking at the Instacart IPO, who made money, Harry, in that Instacart IPO at pricing?
YC and early Sequoia rounds.
Yeah, first 2 rounds.
Yeah.
So these folks are like, okay, I need to go out and raise another fund. I've been sitting on this dry powder for a while. Let me go right out 20, 30, 40, $50 million checks. Because you know what? Even if I'm wrong, I get my money back. And I am the first person in the cap table. So likely, if the outcome is enormous, I can make some money. I'm not saying that's a good thing. I'm just telling you that's what the dynamic is in the market right now.
No, I'm saying that's a fuck thing. I'm going out of my way to say that's a fuck thing. And me and Parker Conrad, not a good person to pick a fight with, by the way, note. But me and Parker Conrad thoroughly disagree. I think that too much cash too early has a net negative impact on 99.9% of companies, unless you are an exceptional allocator of capital, like he is, like Daniel Ek is, like very, very few generational founders are. Do you agree with me?
I agree with you 1,000%. I said necessity is the mother of all invention. And yeah, look, every person that writes that $20 million check or the $50 million, $100 million check thinks that the founder they're backing actually is the Parker Conrads of the world and the Daniel X. The reality of it is there's only a few Parker Conrads and few Daniel X. So you're more likely to create major issues than you are to actually have an amazing company. And here's why. First of all, your talent has gotten way smarter. Way smarter. So when they come in, like, what's the valuation? Oh, you raised 100 million at $1 billion. How am I ever going to make money on this? Because you know what? I've been sitting at a unicorn for a long time, and I'm actually not making any money here for the last 3 years, and I took a pay cut. So one is you've got these people, are the best talent in the world wants to join a company, not on the highest price, but the best price with the right amount of capital for the right risk. Second thing is that this is what we've been doing with founders. They'll come out to us and say, test the waters. Boldstart's a bigger fund. Let me raise 3 to 6. So we're like, okay, how much do you really need? You know what? I'll lead you around now if you want 3, but not at 6. So they come back to us, a few days later and like, you know what? How about 4? And the reason I do that, Harry, is because I want to test them. I want to test them to make sure that they are okay and that they want to operate with constraints around them. Because smart founders, there's a lot of second-time founders that can go out and raise 10 or 12, but there's some smart second-time founders that we just backed at inception, raising 3 or 4 because they want the pressure. They want to take the heat off of the pressure to create and do dumb things and get a next up round. It's much easier to do. They want to hire great talent and they want to be lean.
Do you really find that? I mean, you mentioned one there, but respectfully, I come across them every day where they're very good operators. I'm not dissing them in any way, but they're like, listen, dude, I love you. I want to work with you, but I've got Andreessen giving me 6 on 30 and you're giving me 3 on 15. It gives me way more time. I just chilled.
I'm not saying it's 3 and 15, but I'll move to like the 4, right? You know what I'm saying? So I'm just testing the constraints. That's number one. Number 2 thing I would say is that this goes into fund sizing. And, as I said, I tweeted the whole thing about what an inception round is, and there's 3 kinds. But, the way that we've evolved now is that sometimes I have to play ball, Harry, right? Sometimes there are some exceptional founders where, okay, you know what? I will split an $8 to $10 million round for that exceptional founder, depending on what that price is and kind of where we go. So I'll give you a good example. We'd known this founder, Ian Swanson, for 10 plus years. And he came out, he was most recently running go-to-market for AWS in their AI and ML group. Before that, he sold his other company in the ML ops space to Oracle. And he said, look, I want to raise $10 million to go after AI security. This was in October of 2021. We started iterating with him and his idea and fleshing out the idea. At the time, it was just him. He eventually got 2 co-founders, kept iterating on it. In March of 22, before AI security was hot and AI was hot, we led a $10 million round with a crew. And fast forward, he came out of the gates fast and said the goal was to collapse. This is collapsing around. I'm going to do my seed and seed plus or whatever all at once. I'm going to make it last 3 years because I don't know when the AI security market will be hot. And we closed a $40 million round just, a couple months ago, and he's got a bunch of customers signed up. So my point is that I didn't want to pass on the opportunity. I didn't love the company raising 10 million, but in that case, it made sense. So you've got to be really careful about how you do this.
Can you just help me understand? You touched on the 3 types that you see in terms of the rounds. Can you just touch on them so we have an understanding of those?
So this is what I'm seeing across the board. This is even what Sequoia and Greylock are talking about. And in my opinion, an inception round means you're engaging with founders well before they incorporate. You're helping them battle test and iterate in those ideas. You're helping them pre-sell some of their initial hires. And when they incorporate, you're leading those rounds upon company formation so the founders don't have to dick around trying to raise money for months. And they don't have to dick around looking for 6 people. They come out of the gates on incorporation with 6 people and money, and they're ready to go. So you save a shitload of time. And it's been happening for a very long time. And the 3 kinds of rounds I see at inception are basically this. And by the way, this is not incubating a company. That's not a scalable model unless that's all you do. And there's some firms that do that really well. It's pre-accelerator because at accelerator, you've got to be incorporated to join so you can give them your equity. And it's pre-seed. And the reason I'm saying it's pre-seed is because as pre-seed has gotten institutionalized, a lot of these firms want to actually see a little more product at the door, or taking a little less risky bets around that, to be honest with you. That's what happens when you take institutional capital. And so anyway, the point is the 3 rounds are, there's a discovery round, which in my opinion is less than 2 million. So it's usually like maybe a first-time founder exploring a new market, maybe like WASM, WebAssembly Markup Language or whatnot. And if they, the idea is there, a big market, but the market's really early, so they're going to flesh it out for a while. And the idea is it would graduate. It would graduate to the next round, which would be a classic. And a classic round, in my opinion, would be a first or second time founder. And this is where it becomes interesting. It's about 3 to 5 million. And this is the round that I prefer the most. And it's where that this founder could probably raise more capital in a lot of cases, but they want to be more constrained and like say, you know what, I'm going to take the air of the balloon. I'm going to take $4 to $5 million. I'm going to build a lean team and I'm going to operate. And the reason that this is interesting is because your traditional seed funded company now, Harry, if you look at the data, the median number is 2.7 years old, right? That means they've usually raised a pre-seed round. Maybe now they're out going and raise a seed round right now. So that's really not an inception play. And finally, here's the jumbo. This is the Megatron jumbo round, greater than 5. It's usually a $6 to $10 million round. And it's almost always a seasoned founder like an Ian that I mentioned earlier with a prior exit. They're probably building their next company. It's probably iteration number 2 or 3 on the same idea that they've had and made money on before. And they're maybe reinventing an existing market with a huge TAM. So when multi-stage firms see opportunities like this, they want to supersize it. And they say, you know what? Instead of raising 4 or 5, why don't you raise 10 and I'll give you the whole thing. And that's kind of what I'm seeing in the market today. Those are 3 rounds and they're all people with ideas trying to get going, and they can raise anywhere from 0 to 10. And by the way, I'm saying this is because you'd say this was pre-seed. I wish it was just called seed, because that was what was when I started in 2010, there was seed and then A. And that's what would make the world simpler. But pre-seed usually is a smaller round in people's minds. And that's almost like a negative connotation for a really good founder.
Listen, I totally get you on those 3, and I agree with you. The first thing I go to is, what worries me is people don't think longer term on the jumbo rounds, and say we're just doing a 10 on 50. Yeah, just base case. 10 on 50 is the jumbo, which we both see a lot. We see 20 on 100 a lot. Okay, sure. Let's project this out 12 to 18 months. It takes longer. Customers don't convert like they thought they would. Market doesn't move like we thought it would. You're pretty fucked, because you can't do another 10 on 50. Yeah. But if you raised 3 on 15, you could very easily do 7 on 45. That happens. So you put yourself in a shit position, no?
Yeah. And that's why I sometimes test founders. I know you can raise, they'll come out and say 3 to 6. And I'll say, why not raise 3 to 4? And here's why. And some of them say, you know what? I'd rather have some more comfort in my own mind to have 10 million in the bank, because then I have 3 years of runway. But the reality is having more comfort screws you.
Also, this idea of like, oh, but then it buys me the runway. That's if you put it in a bank and do not touch it. How often does one put it in a bank and does not touch it? Oh, that stretch higher. Oh, that new geography we could open up. Oh, new product. Do you know what I mean?
It's a very rare founder that does that. You know who actually is one founder that did that was Rahul from Superhuman. So we gave him one of the first checks back in Reportive before he's from Fund 1. Fund 2, he wrote his first check into Superhuman. And he raised quietly, he made us put 3 or 4 different checks in seed rounds, in seed notes, just to get our ownership, because we'd always ask for more. He cut us back. That was his strategy. Then he raised a $10 million A round. He put it in a separate bank account and said, I'm not going to touch this thing. I'm literally just going to put it there. I don't want to see it. It's in a separate bank account. I'm only going to operate on the seed money that I had. And Rahul Harry, the guy is he's an operating machine, that guy. So having been through the experience where he's scarred for life, where when he sold his company to LinkedIn, he basically had no money. He's like, I'm never going to be there again. And so in some ways it almost killed him, because he would not move as fast as he could because he had the runway. But I'm just saying, it's a very rare founder that can do that, and most people can't. And you're better off feeling that pressure. When your backs are against the wall, the best people perform. When you're actually too comfortable, you don't perform. That's the bottom line.
So my question to you as a result of this is, when I look at that, seed funds back in the day were 25 to max $100 million. That was kind of how big seed funds were.
Yeah.
This just doesn't work at all. If you're doing classic 3 to 5 million rounds, let's just project this out for people listening. 3 to 5 million rounds, let's take the lowest 3, and we're leading those rounds. Say we're doing 2.5. Okay, if we do 30, which is the average that we're recommending, if you think about diversification, then you're done. On a 100 million fund, the biggest, with no reserves, that's all you could do. Like, the seed fund structure doesn't work anymore, does it?
I'll give you some different math. I think in order to win right now in today's venture climate, you've got to compete with angels, you've got to compete with pre-seed, you've got to compete with seed, you've got to compete with multi-stage billion-dollar firms, period. You have to. That means you need to get ball control in any round that's presented to you that the founder wants to have. Okay. And that means you need to actually be able to write, if someone wants to raise $1 million, just write $1 million check. And that check needs to be meaningful from you. It has to not look like an option. Okay. At the same time, you've got to move all the way up the stack. And for that special founder like an Ian, you've got to be able to participate and lead or co-lead that $10 million round. And so what I'm saying is that if you're ownership focused and you're highly concentrated, let's just say I have 20 to 25 companies in my fund and my average check is $3.5 million. I buy 15%. Okay. You can talk about the next round being, let's just say it could be anywhere from 50 to 150 posts, depending on what the company is, right? But let's pick a number. Depending on the round size, your second check could likely be bigger than your first check. And I've seen that across the board. When I start with a $3.5-4 million check, I'm writing a $4 to $6 million check in the next round if the companies execute. If they don't execute, then, that's another question altogether. Secondly, it usually takes a long time for these companies to get to product market fit, particularly in the enterprise sectors we invest in. It takes a long time to build technical products. You might have to do a bridge or two, and you might have to have the deep enough pockets as your own firm to not rely on others and find the signals and step up. Guy from Snyk, Harry, do you know how many rounds he raised before he raised his A? 3 rounds. 3 rounds of capital before his A. Guess who gave him all 3 rounds?
Were you unwavering when doing that? When you have 3, at some point you must go, Jesus, this is taking longer than we thought.
We did. There was a company Jesus moment I remember with Guy after we did the first seed round, and we're getting traction, but downloads don't equal revenue, right? This was in 2016, 2017. However, he's like, yeah, I got some enterprise customers here. I don't know if I want to do it. I might create this new bridge between the enterprise and my cloud, and it's going to be this thing called an agent broker that I'm going to create, and I can charge $50K. And he goes, I don't know how long it'll take. He did it. It took a few days. He built it out, signed a few customers. We're like, boom, here you go. Right. So if you are actively involved and engaged on the board from the very beginning as well, and you have a very concentrated portfolio, you see signals. And the signals that we see may not be the signals an outsider sees. And once again, the important part is if Guy went out trying to raise capital from someone else and I didn't have enough capital to give to him, he would have gone out of business. Okay. So that's where you have to kind of come in. You've got to know the founder. And yeah, do we get all the bets right, Harry? Hell no. We don't get them all right. But if 1 or 2 of them work, within the model. So all I'm saying is that the fund size actually can be larger. And I don't think it should be $1 billion. And I think 50 million, it shouldn't be 50, but I think a fund size between 150 and 250 for doing this in a highly concentrated position with ownership and doing it in a way that allows you to write bigger checks after the discovery round to help a classic round, raise a little more of an extension and to support these founders through the B round. I think it's 150 to 250. I don't think it's your $100 million fund of old.
But I'm saying it has to be 150 to 250.
Oh, good.
It's not
we're on the same page.
We're on the same page. I'm saying it has to be. You cannot make it work otherwise. And also, you was horrible with the 50 fund size. Is you do need to write 500 to 1 million. Ed, if I'm writing 500 to 1 million, I'm a pain in the ass to you. If you're trying to bring me into the round, even as a friend, you're like, ugh.
Dude, I've been there, done that, Harry. I've done everything. We started out with $1 million fund in Boldstart 1. This was in 2010 when seed was the first round of record. And then the pre-seed category was created because seed investors weren't taking as much risk. And now the pre-seed investors aren't taking as much risk, which is why I'm saying let's do inception investing. The reality of it is that the market and the world has changed. And the point is that, you need to have ball control. You need to be able to do anything.
I get you, and so many ways I want to take this, but I chat to Jason Lemkin a lot. He's a good buddy of mine, and he's like, "Yeah, but I don't know if enterprise SaaS actually is investable really anymore." And his reasoning for that, before I just destroy, Boldstart's thesis, is essentially, with the expansion and inflation of entry point, the price that you pay when you come in, and the rationalization of upside being public markets and revenue multiples, it's not possible to do as well anymore by any stretch. If you think about any growth investing in enterprise SaaS, it definitely isn't.
When we started this fund, Elliot and I were like, man, if we get $1 billion outcome if we orient our funds to getting $1 billion outcomes, that'd be absolutely amazing. What we didn't see was that you could orient some funds towards $10 billion outcomes, but that's kind of not the fund size one. Let's say we move back to a world where $2 to $3 billion outcomes would be really fucking amazing.
Yeah.
Well, guess what? If you have the ownership that you target, let's say in our case, it's 15%. Some people may have more. If you are disciplined on your entry price, dude, I'll give the counter argument. Enterprise IT spending is fucking accelerating right now. I mean, it's, look at Microsoft, and they had 11 down quarters. They had their first up quarter the other day from re-accelerating numbers. So, and I'm just saying the cloud stuff, we're still only 25% of the way of migration from on-prem to cloud right now. And cybersecurity spending, the reality, the wonderful thing about cybersecurity is that there's always a new attack vector. And JP Morgan, for example, spent $1 billion a year in cybersecurity. Guess what? They're always looking to protect their next big thing. So my perspective would be, I love it when guys like Jason say it's overcrowded, because I'll just keep putting my money to work where I'm doing it and just being disciplined about it. So I think there's a massive upside to that from where we are.
I do think people don't anticipate levels of dilution enough. I've been in this game, sadly, long enough to know that dilution really hurts. And your 15% entry turns into 9% on exit, often a little bit more sometimes. My point being, do you have any lessons, observations from the impacts of dilution and just what it actually ultimately means when it comes to cash back?
Yeah, well, capital efficiency matters, period, right? So that's number one. And to that point, you will never find Boldstart, for example, funding companies where, they're raising $20 or $30 million and 2/3 of that money goes to NVIDIA. Because, if my LPs went to actually invest in NVIDIA, they can invest in NVIDIA. They don't have to take haircuts from fees from me to do that, right? So that's number one. So those aren't capital efficient businesses in my mind, and they're lower margin businesses. Number two is this is also why, Harry, we created the opportunity funds. So our opportunity fund right now is almost the same size as our core fund. So our strategy is to inception invest. It's to continue supporting the best founders as they keep growing, to maintain that ownership. And then, after it hits the Series B, we're still able to maintain that ownership and our board seats as the best ones go.
So I'm just pushing you here for fun. These are not my opinions, obviously, but I tweeted yesterday, there's a special place in VC hell saved for pre-seed investors that take board seats. Am I wrong?
Yeah. So look, I don't know what pre-seed is, first and foremost, because if you're raising $500K to $1 million, that's what I think of pre-seed, then you probably don't need a board. Yeah, you don't need a fucking board. Here's what I do. I go the other way. Founder, what works for you from a cadence perspective? Number one. Number two is, if you're doing a classic round of you're raising $3 to $4 million, I like to tell the founder that, hey, you should probably not do a series of safe notes here, because you never really know what you own, especially on conversion. You want to actually do a proper round. What we'll do is we'll put a board together. But, as I said, we are going to have our regular dialogue based on the cadence that works for you. Because usually the first 6 months, they're just heads down building. I'm not going to be helping them build their product, Harry. I'm investing in them to build the product of the future. That's their job. They will reach out. The best founders reach out to us and know exactly what to ask for, know exactly how to ask for it, know exactly when. And then what I say is, let's start doing a quarterly cadence for the board. I just want text, no fucking pretty images. But what I want to do is prepare you for the day, a year from now, 6 months in, so 18 months from funding, that when you have a board, you at least have this cadence going, and we're actually prepping you for that pace to go. So it's more of a preparation stage than anything else. And it also depends on the founder. I love the best founders, in my opinion, Harry, just ping me when they need me. They'll send me a text, they'll send me WhatsApp, they'll send me iMessage, they'll hit us up in Slack. But, putting onerous frameworks around founders where you need to talk every week or 2 weeks or whatever, or having every monthly board meeting cadences, there's no set rule. It really depends on the company, the founder, their experience. And the point is, you've got to develop a really trusting relationship with that person.
I totally agree with you in terms of it being kind of preference led, and absolutely when I said it, I was talking about kind of the 500 million.
I saw that, by the way. I was like, who does weekly or bi-weekly calls? I was just like, that was...
Do you know what was so funny? Though Keith Raboy responded to that. It's only what Sequoia's been doing for the last 50 years. And then I had another message from another GP that said, probably one of the most successful investors of the last 10 years, that said, if your founder does not want a weekly call with you, you clearly are not adding much value and a shit.
Here's my perspective. Look, we take board seats for the most part, but once again, if they're smaller, really much smaller rounds, there's usually no need for it. And you have that relationship, right? And they're going to reach out to you. I don't want to back someone that doesn't think we can help them and add value, and they're not going to want to take my money either, right? So that's why I stay focused in my swim lane. I'm not deviating and doing biotech or like health tech investing. It's just not my area of expertise.
Ed, we're seeing like macro not looking great. We're seeing interest rates potentially going higher. We're seeing global conflict. I mean, the world is not in great shape. And we're talking about kind of 20 on 100 seed rounds. Like, is seed immortal to macro externalities, or will this shake down to the seed markets eventually, do you think?
I don't even know what the fuck a 20 on 100 post is anymore, frankly. I mean, that's just... I think at the end of the day, dude, it comes down to being disciplined, right? And I mean, I don't know. I think that there's some lessons that haven't been learned. And I'll go on my rant. I mean, I think this whole AI thing, frankly, I think AI is the most transformational thing that we're ever going to see in a long time. However, I still think it's really fucking hard to make money there. This is a place I totally agree that where data moats matter. I think incumbents, anyone could take a API call to OpenAI and test things out. I mean, fucking look at Adobe. They've done an amazing job kind of going after that space. So I think chasing anything with a .ai in their domain or an AI thing, I think is insane. However, I do think there's some opportunities there, but I'm not going to be funding these things at 100 posts. That's what's regularly happening now. I'd love to hear your thoughts, Harry. You're probably seeing a ton of AI, LLM, next-gen stuff. And I just think that this is just like I saw in the internet bubble. Everything had a .com on it back in 96 because I saw that. I lived through that shit. And we're going to see the same thing. There are going to be some massive companies built, no doubt, but it's not going to be built chasing a portfolio of 100 posts across the board.
I would say unlike other trends where I remember when it was like chatbot trend craze, the D2C craze. Obviously, I'm a generalist investor, so we will move with trends. But like I now see 85% of our deal flow now purely is AI first deal flow.
But what does that mean to you, right? Because I just did an analysis of my portfolio, okay? And I just said, okay, so currently in the portfolio of our companies that are running from funds 4 through 6, 55% of our portfolio companies have an AI related offering today. And within the next 12 months, okay, 80% of the portfolio will have an AI offering. And in my opinion, does that mean I'm an AI investor? Well, if you want to call me an AI investor, you can, but I don't really think of myself that way. I always think about what problem are you solving first? How are you doing it uniquely? And oh, by the way, if you're adding AI, very cool, then let me know kind of how people will pay for it and why it's going to be better. But versus I'm an AI company. I don't know.
I totally get you. I think like anything that offers it like as an enhancement, which is like, I don't know, Lattice that say, hey, we now have AI to make more intelligent human resources automation or whatever, decisions around your people management. That's not an AI company. Yep. This is like in the front one-liner, we are an AI-powered wealth manager. We are an AI-powered e-commerce conversion optimizer. That's what I call kind of like
versus being an e-commerce optimizer that has AI in it. I'm just doing the flip way around.
That has 100 people in a third world country selecting which ones.
Exactly.
But no, so I see that. I think honestly, the people best suited to win are actually your Canvas styles of the world, who actually, dude, have all the data, but none of the incumbent regulatory downsides of being a public company. I think it's your high growth pre-IPO companies.
I agree 1000%. Did you see Snyk? I don't know if you caught up with Guy recently, but Snyk has Snyk Deep Code AI, right? And Guy actually had bought a company 4 years ago with his own machine learning expertise. And the strategy there is that, hey, you know what? Everyone's using GitHub Copilot, but they're also using Code Whisper and they're using everything else. But guess what? There's a hallucination problem. And you need one kind of, and you don't want the fox guard in the hen house, meaning that how are you going to trust the company spitting out the code to also secure the code? So you need a Snyk to come in and you need AI to protect AI. But the point is that we wouldn't even be there if you didn't buy the company, nor if we're sitting on a data moat with hundreds of thousands of customers using them fixing vulnerabilities.
Totally. But also he probably couldn't have done that deal in terms of buying the company or moving at speed if he was a public company. It's not possible.
Exactly. And he wouldn't be able to do it now either because he did it when AI wasn't hot.
So I think M&A is going to go to shit. I think anything sub $1 billion is not meaningful enough for M&A teams and corp dev teams to actually engage with. And I think anything over $1 billion is going to be incredibly arduous for them to get over the line from a regulatory perspective. Do you agree, or am I overly negative?
I think we're going to see a lot more M&As kind of coming ahead right now. And I'll tell you the kinds we'll see, right? All right, well, let's look at it. There have been a lot of companies, and there's 1,000+ unicorns out there right now. Not all of them will go public. Many of them are overvalued right now. And guess what? There are probably some growth investors sitting around saying, you may have 5 to 7 years of runway, but if I can get my money out right now on the tech stack, on the stack right now, get my money back. And investors, by the way, down the stack will get their money back. And by the way, founders will probably make money. Let's just say if there's an opportunity to go do that, that would be a brilliant opportunity for people to maybe exit out, take their 1x, and they can go reinvest it somewhere else. And I'm talking to lots of growth investors who are kind of looking at saying, yeah, I mean, you know what? If I can get 1x out after a few years and actually reinvest that stuff into something else at a better price or do something. So I think that the realization of holding on to these
they're not getting, I don't mean this, they're not getting that, dude, because the founders are sitting on this pile of cash going, you're not having your money back. And they're going,
no, it depends. In situations like a Loom, look at Loom's situation, right? Where they had, that was a great exit for the founders. Look at those numbers. Fucking incredible, dude. God bless them. Right. Yeah. So it cleared the pref stack, even though the last round investor came in at a much higher price than the headline valuation. It was a huge win for the founders. So I'm pointing at situations like that where in the past, you've probably heard stories about VCs not wanting to get 1x back. Well, guess what? You're going to see some smarter investors be like, you know what? Maybe I'll take that money off the table now and put it somewhere else. And the founders in that situation killed it. I mean, they should. They built a great business.
I loved the TechCrunch article where it's like, Joe put a positive spin on it. I'm like, I'm not fucking surprised he put a positive spin on it. I messaged him afterwards being like, what a joke.
Oh yeah, incredible. And so people then say the investors failed. Well, guess what? Maybe they didn't. Maybe that was a great opportunity for them because they can go reinvest and do some other things with it. And it's a huge win for the founders. So I guess what I'm trying to say is I think those growth kind of funds that put the money at the peak, I think the ones that deliver 1x or slightly above will probably do very well. We'll be above, because there'll be a lot of ones that are underwater, is my opinion.
So I get you. I do want to discuss the growth element because, we've spoken about the frothy nature of seed today. Growth seems to have died, though. It's what everyone says, and it's definitely what I see more and more. Do you agree, or do you actually think that there's resiliency in the growth market too, and that we're overly negative on that?
Look, first of all, I've been doing this long enough. This is year 27 for me, where things are never as good or as bad as it seems, right? So, and the echo chamber is stronger than it's ever been with social media and everything else. But my point is that, yeah, the overall numbers itself in terms of growth round valuations, yeah, they're fucking down big time. Number two is the valuations from growth rounds. I think, if you look at Carta's data, I think the seed round was the Series C was down from 475 to 375 already, or 275, something crazy like that. So yeah, they're getting crushed. But however, there's still pockets of opportunity where people are going from 1 to 3 to 4 million in the infrastructure space that I see to 10 to 12 kind of on their forecast. And they're still raising at 250 to 400 now.
What are you saying to your founders? Like the founders that are going out to raise and they're like, shit, that's a really compressed price. Like 275. I thought we were more at the 500. Are you saying it's a new world, take it? Or are you saying, hey, take another 5-10 million from us and push it out 10 to 20 months or 18 months, whatever that is, and the markets might be different then?
Yeah, so I have a couple of thoughts. One is that when the markets are pretty hot, we got ahead of it and got a lot of our companies funded with a lot of capital. So, I think the bigger challenge we might have is that there's some companies that have too much capital. We had to work with them to get more efficient. For the ones going from, seed to A or kind of A to B, I was doing the math. I think we got 15 next rounds done from our last annual meeting from a year ago to now. So we did get a lot of rounds done in the heat of the market. We even got a crypto infrastructure round done and an up round, a $10 million A round done in this market. That founding team, by the way, happened to go from 0 to 1.4 million of ARR from a standing start in 16 months. But the point is that the best founders now aren't, as we tell them, let's not worry about what the best price is, because the best price could once again set you up for performance issues down the line. a lot of talent. We want you to get the best partner who believes in your business in the longer term at a fair price. I think the days of founders being obsessed about the highest price possible, I think for the most part are over. And I think the smarter founders want to actually, get fair prices, above average prices, but they also know that they don't want to take in way too much capital, which means more dilution. And they also don't want to set the bar too high because they see what's happening in the exit markets right now. You limit your options to create value when you take money at too high a price. You're not going to be able to sell your business because someone's not going to pay multiples on that.
I agree with you and I get you in some ways, but then I was speaking to a founder the other day operating, guess what, in the AI space. And they're like, yeah, I get you, Harry, but I need $10 million. Like we need a lot of compute.
As I said, I'm not playing in that AI compute game right now. So I do understand the need for those founders to go out and raise capital and go do it in the way that they need to. But, I'm just saying that history rhymes. And, you and I both know there's some lessons that we should probably learn from the last 2 years.
Is there any other lessons that we should learn? Because I'm looking at some of these. I sent you that deck for the ridiculous round. And this was from pedigree investor who's been through cycles at one of the best firms. Are there lessons who should know better? Are there lessons that we should have learned that seemingly haven't?
Certain firms that have lots of capital to work, checks like that, a $10 million check, maybe a complete option check for that firm, or maybe they're almost fully invested right now. And so I don't know what the reasons are, but, I'm just saying that everyone along the stack has to do something that makes sense for them. I mean, just from my perspective, you won't be finding me participating in $20 to $100 million inception rounds from a seed firm or an inception firm, but the multi-stagers are doing it across the board. These are option checks, still option checks for them.
What would you say to founders? What do you advise founders looking at this today going, oh gosh, you've given me 3 kinds of inception round. There's all these different options. Which one should I do?
I think the founders, for the most part, come to us knowing kind of what they want as well. They kind of know, the ones who are more confident about their abilities, who have been there, done that before, usually will probe around and start with a $3 to $4 million round. And then sometimes what happens is they will get supersized by a large multi-stager. And then you need to make a decision. We need to make a decision is, do we want to, co-lead in that one or not? And then, as I said, there are other founders who come in like in the WASM infrastructure space that know it's very early. And we're like, look, we can write a check like tomorrow right now for a $2 million round because there's not much we need to do, right? We know who you are. We know where you came from. We know you can build. And then let's figure out, and you can get going right now without having to hassle and raise money and tell people what WASM is. They can go out and raise kind of that next round later. So it really depends on every situation. I don't try to tell anyone what to do. They already have an idea in their mind, and you kind of work with them as they touch the market to see how the market responds.
My biggest lesson from the last few years was actually just to sell at some points. We were always told lean in. Bullshit. You need to lean out strategically over increments over time. That was a big lesson for me. What was the lesson for you in hindsight you wish you'd done differently?
I would say that the biggest lesson is not much different from you. 2 lessons that I think about. One is no matter how disciplined you are, we talked about too much cash can kill startups, right? No matter at any stage, okay? No matter what, right? It just, as I said, there's a death spiral that can happen if you miss a quarter or a quarter or two, and just the pressure goes up. And the last batch of hires, who are usually the largest percent of your business, if you're growing, if you're in hypergrowth mode, are feeling like they're underwater, right? So that creates lots of issues from that perspective. So that's number one. Number 2 would be ownership matters always, but also you have to balance that out with, valuation, valuations as well. So I'll give you an example. There are so many preemptive rounds happening over the last few years where, every 6 months people are raising rounds, that usually there hasn't been enough data points to merit kind of coming in on the next round or the round after. And the company hasn't performed enough for you to de-risk yourself in between rounds, because let's say you got 3 rounds done in 12 months. And there should have been situations perhaps where we shouldn't have gotten into every single one of those rounds because maybe it wasn't de-risked enough between the time you closed a round and the next round. I think moving forward, since there are less preemptive rounds, there is more time to understand, has this been de-risked enough? Is this an appropriate time to lean in even more to actually do your pro rata or get more ownership? So that's kind of what I'd say. Ownership always matters, by the way, on these exits, particularly in a world of lower multiples. But you've got to be careful about what that, how much you lean in.
I take a different approach to pro rata and reserves than most people, and I think many LPs are shocked by this. I think actually it's often predicated on very misleading signals, and immediate traction doesn't signify sustainability over the long term. If I were to invest according to the signals, I would have put the most money into Clubhouse, Hopin, Be Real. They were like the outperformers within the first year of investing. They weren't the most sustainable. Snyk is not the most outperforming in that first year. And so I find most managers invest, observe for a year, and then double down on what's working. But what's working often is unsustainable, and it's your Snyks, your Figmas, your BigIDs, which actually may take a bit longer, but you wouldn't allocate to them if you were doing it on traction.
Well, we kind of did, right? I mean, BigID, we gave 3 rounds before their A round 2, but their traction was different. I mean, I'm just saying, so to your point, it's a meandering path to getting to kind of product market fit. And what I've seen is that the easier it is to build a product and the more social the product is and the more, let's say, PLG oriented something is the easier that everyone tweets about it and goes out there and talks about it. But the reality is, to your point, is that doesn't mean those aren't the signals that you really want to be investing in right now, even though some people may be writing checks against it. The signals you really want to be investing in is this product built for the long haul? What are people paying for this? And, what is kind of the technical moat around kind of their business, right? And so some of the hardest problems to solve will take longer and it'll look like your slowest plodding company to start with. But in the long run, to your point, these things are the ones that can actually go, hit the J curve pretty quickly.
2 final ones, and they're associated. What's your biggest investing win, and how did that impact your mindset? And what's your biggest loss or mistake, and how did that impact your mindset?
Yeah, so I'll give you this. So my biggest win to date, and win I'll call it realization, was kind of leading the round in inception with Kustomer with a K. And that was like, I don't know, 8 or 9 pre, I think. And we're like, basically wouldn't let the founders out of the room. Wanted to give Brad and Jeremy the check right there. Like, hold on, let me incorporate first. Let me get my 83B election filed. You guys, and by the way, in the enterprise space, I'd already been the first investor in LivePerson, which was one of the first hosted chats back in the day. So I was that first check-in, and that went public. I did GoToMeeting, which had GoToAssist, and we sold that to Citrix, and then eventually, did 600 million of AR. So I knew the space cold, and this was their third startup, right? This was one of the ones where you're in the room, you meet them, you got the energy, you're like, yeah, fuck yeah, you got to do this, right? So fast forward, there's some tough times. What we learned in that process was that someone going after an incumbent at that point in time was Zendesk. It takes longer. You know why? Because no matter how visionary your product is, and they basically built the data architecture that said, hey, instead of having each interaction be a ticket, whether it's email or chat or whatever, they're all different tickets in different databases. Let's create it as a customer. So it's Harry, and Harry chatted with me. He did a voice call, whatever. And if you do that, number one, and then 2 is append custom data. Like you could take in, for example, from Ring, Wi-Fi data in. And when you reached out, I immediately knew everything about you from any signal that you reached out to me. I knew that your Wi-Fi was down while your doorbell was down. If you did all that, we could actually re-architect and rebuild and actually have better customer support. The problem is that we went out to the market to sell the products and like, oh, you need a knowledge base now. Oh, you need FAQs. Oh, you need this. And every time we're about to sell something, we're like, shit, you need more product. So to go after incumbents, you actually have to build more. So it took us longer, and we had to give them a bridge round between the A and the B. There's not a reported price, but let's just say it was over $1 billion according to the news. And that was my first kind of really big win.
And so the lesson there is that you need to build more depth to chase incumbents.
Yes, you do. So no matter how big of a vision you have, you still need at least the table stakes of, checkbox of 4 things that they may need before they even believe in your vision. So it takes longer. So that's one. And that has implied kind of some of our investments now, because there's a lot of founders coming back and reimagining things. So that's what happens in enterprise. It's the same shit getting rebuilt every 10 or 15 years in a different way with a different pitch. Second thing I'd say is my other potentially big win right now is Snyk. I mean, it hasn't been, exited yet, but, we had funded Guy in the first company, right? When he sold his company to Akamai, and I bothered Guy every quarter. I was like, hey, when are you starting? When are you starting your next thing? And eventually he's like, I got an idea. And I was like, those first 2 ideas are okay. The first one's terrible, but the third one, I'll give you a check right now. That was Snyk. Those are some hard times, right? In terms of he was creating a new category. So that's a different kind of play, creating a new category, category creation takes a long time too. It took him 2.5 years to kind of get out there and get his first, 2.5 to 3 to get his first $1 million of ARR. And there are some times where it was really fucking slow. But the signs were there. The product love was there. The product was cranking along. The pipeline was building, just wasn't converting. It just takes time. The biggest mistake I made probably would be, as I said earlier, is that when companies do preemptive rounds and preemptive round after round after round in a short period of time, I never fault myself for the first check. Right? Because you have to believe in the first check. No, usually never fault myself for the second check, but the third check, perhaps, that should be an opportunity. We're like, you know what, dude, you own enough, lean back a little bit. So ownership matters, but you have to be careful kind of the pricing and everything else. And you can read between the lines here in that one, but that would be leaning in too much, too quickly without enough signals changing things from those rounds. So those would be the two balanced answers.
No, listen, I love that, and I totally get that. I want to do a quick fire round with you, Ed. So I'm going to say a short statement. You're going to give me immediate thoughts. Does that sound okay?
Yeah.
So will 99% of money going into AI startups today go to zero? Venture money, that is. I
don't really know what an AI startup is. So I think AI is going to be incorporated into every piece of enterprise software where it makes sense and where someone will pay. So in my opinion, that'll probably be 80 to 90% of the software anyway. So I don't even know what the fucking AI startup is, but let's just say the money chasing all these LLMs, there'll be a lot of money vaporized for sure. Will more money go into AI startups next year than it will this year? Once again, I don't know what the fuck AI startups are because every company. So let's just say if every enterprise software company has some AI related feature to it, then the answer is yes. Because in my opinion, every enterprise software company is going to have some AI incorporated into their product. What would you most like to change about the world of venture, Ed? It's gotten so fucking competitive out there, man. It's insane. And there's too much money out there chasing things. And I think there's a lot of irrationality right now. I mean, as I said, I'm looking at the inception rounds, right? I laid out a framework from 0 to 6, 0 to 8, 0 to 10. But, you're getting $30, $40, $50 million, inception rounds done. And I think it's just bonkers, man. And it skews people's brains and memories. So I just wish there was some more rationality around, what everything and everyone was doing. What do you advise LPs today looking at the landscape, trying to get a grip on it, trying to understand what's going on? Well, look, I mean, the LPs will advise me too, but the answer is that I think being first on the cap table really makes sense in terms of making money in any environment with multiples compressed. I think ownership is going to matter. And I think 3 is, I think there's going to be a new generation of firms kind of coming around that are building, different businesses and different VC funds and trying things differently. I think that there's some legendary brands out there. And I am so impressed with how long they've been around and the teams that they have. But I think there's also, given that the industry expanded a lot, the question for them is going to be who's going to be the next generation of funds out there that are going to win for a long time. What will crack open IPO windows, do you think? We mentioned Instacart earlier. Instacart didn't. Klaviyo sadly didn't with it. I think it's very simple. Mr. Jerome Powell signaling to the world that interest rates are under control now. And the air has been taken out of the balloon and the interest rates have to go down. I mean, there's a direct correlation. I think that I had some of my friends at JP Morgan gave me a chart. At its peak, I think any company growing greater than 40%, and there's an inverse relationship to interest rates and forward valuations, 35 times forward. Do you know today that number is at 6.8 times forward as interest rates kept hiking up? And the 5-year historical number is 13.9 times. So do I think we're going to move back to a world of 35 to 40 for companies going greater than 40%? Never again. Do I think 6.8 might be the low point? Yeah. Is it the 5-year kind of average of 14? Yeah, let's just say it's somewhere between 10 and 14. So you've got to build your business and your investment strategy and your ownership strategy around looking at a world where we get 10 to 14 for the best companies forward next year's numbers. And if you can do that, then I think you'll have an opportunity to make a lot of money. If we project out, where do you want Boldstart to be in 10 years, Ed? Like when we think about firm design, what do you want Boldstart to be? I think we're pretty much the same that we are now. I mean, I think what we're going to do is that, we have four investment partners. We've got an operating partner, Anna, out of London, who you may have met with. She worked with Guy at Snyk. She was employee 4. I did. So we're going to continue to add more operating partners to help really these inception stage founders get there faster. Like in Anna's case, she's bringing product expertise to the team that she learned from Snyk, all the hard-learned lessons and things that didn't work well, along with the things that went well with our, founders. And it's been working like a charm. We have a few others identified that we're going to bring to the team, but I think we're going to stay where the market is in terms of we want to be in that inception round. I don't want to lead A rounds. I don't want to get so big where I feel like I have to put money to work to make bad decisions. I got to tell you this: we only did. Last year, we announced our two new funds, which were our largest ever. We only did 3 net new lead deals in the back half of last year because we thought the markets were going a little crazy. We were seeing a lot of incremental ideas, not big ideas. And then in this first part of the year already, we've done 7 net new, and we have an 8th one we're about to do. So we'll be up to 11. And that's not because we're chasing AI or anything like that. It happens to be because we have a lot of founders that we've known for a long time, second and third time founders coming out of the woodwork, ready to get going. So I want to stay in that range. And whatever you call it 10 years from now, I hope it's kind of inception investing. I want to be in that place and no bigger. I don't want to be an asset manager. It's really hard to deliver returns in this market the bigger you get.
Dude, listen, I love chatting to you always. I can't thank you enough for this. And this has been such a pleasure as always, man.
Dude, thank you. Your questions just are piercing questions, my man. I love working with you, and thank you. It's been a lot of fun.